Good day, Miss. I am Rance Ainsworth Ong, and we are Group 3. The topic which we will be reporting on is enterprise risk management. But before we begin, we need to first understand what risk management is. So, risk management is the process of developing and implementing decisions that manage and reduce the negative impact of risk on a company. It is also setting the best course of action under uncertainty. And these businesses will protect itself against these uncertainties by focusing on controlling or mitigating these risks. Insurance premiums and claims expenses and reputable damage or reduced productivity are some of the examples of the probable costs a business will incur if it does not manage its risks. Now, what is enterprise risk management? It is a systematic process of detecting and minimizing risk within an enterprise or organization. It is the continuous process wherein, after detecting the risk, they deploy the necessary responses for it. Here on the next slide, we can see a guideline on how risks are identified, assessed, and dealt with by the Risk Oversight Committee or whomever is in charge with the responsibility. So it first starts out by monitoring the performance, and it is usually done by assessing operations and seeing if everything is running smoothly as it should. Then once a company finds out that there is something wrong or something affecting their operations, or they aren't hitting any of their objectives, they need to identify the cause. Once the cause is identified, they check to see how much of an impact this risk may have and the likelihood that comes with it. As mentioned a while ago, developing a response to these risks are what makes up the cornerstones of ERM. So the typical responses would be to avoid. You are cutting off any possibility of it posing a threat to your enterprise, or reduce when you bring it down to within acceptable limits, or when you share or transfer the risk, wherein you delegate the responsibility or the risk to another party or a third party, or if there's no other choice, then we have to accept it. So why is it important that we manage these risks? So it is important because it saves on resources, which are the people, your income, assets, and most especially your time. It also protects the public image of the business or the enterprise. It also protects the employees from any harm. It also prevents or reduces any legal liability, as well as protect the environment. Now we know its significance, the objectives of ERM will now be explained by my fellow groupmate.
Good day. I am Maxine Ayratan and I will be discussing the objectives of enterprise risk management. As mentioned earlier, risk management reduces the negative impact of risk in a company. This includes assessing possible risks and implementing risk responses. Therefore, its goals are to identify potential problems before they can occur and have a plan to address them. As enterprise risk management is a top-down, firm-wide strategy, it aims to develop a holistic view of significant risk to the achievement of the entity's objectives. Risk management has the following objectives. First, anticipating the uncertainty and degree of uncertainty of unplanned events. As there is always a possibility of risk management should identify and analyze various associated risks, which can help management identify them at its early stages and take the necessary steps to avoid it. This will enable management to be prepared when unplanned events occur. Second is channelizing events to happen the way they are planned. Efficient use of resources and communication within the organization helps management in their strategic planning and achieving their goals. It helps ensure activities and operations are going as planned. Third is to correct or fix deviation from plans when they occur. Effective communication of risk within the organization helps in spreading information about the risk around the organization in a timely manner. This helps employees identify risk at its early stages and enable them to correct and fix it as soon as it occurs. Fourth is ensuring that the objective of planned event is achieved by alternative means when the means chosen proves wrong. As appropriate risk respondents are already thought of and planned, alternative means are available when the chosen one is not effective. This lessens the negative impact of risk on the business as another alternative can be readily implemented. Lastly is to minimize the damages of risk. Risk and threats are part of every organization. Risk management should develop techniques and strategies to avoid and reduce the effect of these to the business and monitor performance within the organization.
Hello, I am Nina Jane A. Fernandez, and we have already discussed what is risk management, its importance, and its objectives, but we still haven't defined the word risk. Generally, risk is the possibility of something bad happening. It involves uncertainty about the effects or implications of an activity with respect to something that humans value, often focusing on negative. In business aspect, risk is defined by those as the chance of financial losses due to random changes in underlying risk factors. It is also defined as a random event that may possibly occur, and if it did occur, would have a negative impact on the goals of the organization. Risk is composed of three elements: the scenario, its probability of occurrence, and the size of its impact, if it did occur. In our lives, we can't avoid risk, as it is present in every decision we make. The same as in the corporate world, it is also necessary to recognize risk, as it allows a company to obtain competitive advantage and generate profits. Shown on your screens are the following types of risk. First is the political risk. It is the unwanted consequences of political activities that will have effect on the value of the firm. The political component in the country risk can be subdivided into two categories: the internal political risk and the external political risk. In the internal political risk, it arises due to internal conflicts such as racial or religious riots, rebellions, rural insurgency, or political turmoil. On the other hand, external political risk is exposure to loss as a result of acts such as war or occupation by foreign powers. The possibility of such political upheaval needs to be carefully evaluated. So for the second type of risk is the country risk. Country risk is a broad concept encompassing sovereign, political, as well as other forms of risk like economic, social, and external risk. Since country risk is the sum of total number of different types of risk, assessing country risk would mean the evaluation of each of these risks that contribute towards it. The country risk is an all-embracing term incorporating all types of risk a business encounters in offshore transaction. Country risk is inherent to dealing of state or any overseas business. The assessment of country risk involves both qualitative and quantitative analysis of political, social, economic, and natural conditions in the country in which the borrower operates. Next, or the third type of risk, is the economic risk, which is concerned with the general economic climate within the country. The following items that I will mention are the factors that reflect the economic climate of a country. First is the level of affluence enjoyed by the country. Second, the growth rate of income. Third, the nation's propensity to save or invest. Fourth, the stability of prices, or in short, the inflation. Fifth, characteristics of the labor force. Sixth, level of sophistication of the financial statement. Seventh, level of foreign debt outstanding. Eighth, major income earners or exports under sensitivity sensitivity to overall global economic changes. Next is the extent of dependence on major export items. Other type of economic climate is the trends in balance of payments. Next is the level of imports, level of reserve and credit standing, and lastly, the fluctuations of exchange rate and controls on foreign exchange. For the first type of risk, which is the social risk, it refers to the possibilities of loss due to factors such as religious fanaticism, ethnic polarization, dissatisfaction among the people as a result of wide disparity in income distribution, or regionalism. These sociological problems eventually lead to riot and revolutions resulting in loss of lives and property. It is considered as risk as economy plagued by riots and revolutions will undoubtedly face problems. So let me hand you to Win as she will continue to enumerate the other types of risk.
I am Win Pescadero and I will discuss the remaining types of risks. So to continue, the next type of risk is the external risk. External risk is said to often include economic events that arise from outside the corporate structure. External events that lead to external risk cannot be controlled by a company or cannot be forecasted with a high level of reliability, therefore making it hard to reduce the associated risk. The external risk is also divided into three types, which are the economic factors, the natural factors, and the political factors. Economic risk includes changes in market conditions. As an example, an overall economic downturn can lead to a sudden unexpected loss of revenue. Next is the natural factors, which includes natural disasters that affect normal business operations. And lastly, the political factor, which comprised of changes in the political environment or governmental policy that relate to financial affairs. Changes in import and export laws, tariffs, taxes, and other regulations all may affect a business negatively. Now, we move on to the next risk. For the next type, we have here the business risk and the financial risk. These two are the different types of warning signs that investor must investigate when considering making an investment. First, let's talk about the business risk. So business risk is the exposure a company or organization with factors that will lower its profits or lead it to fail. A company's business risk is determined by how it invests its funds, for example, the type of project which it undertakes, or it refers to the basic viability of a business or the question of whether a company will be able to make sufficient sales and generate sufficient revenues to cover its operational expenses and turn a profit. While financial risk is concerned with the cost of financing, business risk is concerned with the cost or like other expenses a business must cover to remain operational and functioning. These expenses includes salaries, production costs, facility rent, and office and administrative expenses. Business risk is often categorized into systematic risk and unsystematic risk, which is on the next slide. So first, for the systematic risk, it refers to the general level of risk associated with any business enterprise or the basic risk resulting from fluctuating economic, political, and market conditions. Systematic risk is an inherent business risk that companies should have little control over or other than ability to anticipate and react to changes in conditions. The effect in systematic risk causes the prices of all individual shares or bonds to move in the same direction, meaning that these movements are the response to the fluctuations. It should be noted that the systematic risk cannot be eliminated by diversification of portfolio because every share is influenced by the general market trend. Moving on to the next category of the business risk, we have here the unsystematic risk. So this risk refers to the risk related to the specific business in which a company is engaged or more like it comes from known and controllable factors. This risk is also called non-systematic risk specific risk, diversifiable risk, or residual risk. In the context of an investment portfolio, unsystematic risk can be reduced through diversification, meaning, for example, if you buy shares of different companies, you can reduce this type of risk. Next, we go back to the financial risk. It is primarily influenced by the level of the financial gearing and is the possibility of losing money on an investment or business venture. It is associated with the capital structure of the firm and is concerned with the company's ability to generate sufficient cash flow to be able to make interest payments on financing or meet other debt-related obligations. A company with relatively higher level of debt financing carries a higher level of financial risk, since there is a greater possibility of the company not being able to meet its financial obligations and become insolvent. Some of the factors that may affect a company's financial risk are the interest rate changes and the overall percentage of its debt financing. Moving on, we have here the market risk. So market risk is a risk of losses in positions arising from movements in market variables like real, social, political, and economic events that triggers the prices and volatility. This type of risk exists because of price changes. So the standard deviation of changes in the prices of stocks, currencies, or commodities is referred to as price volatility, which is rated in annualized terms and may be expressed as an absolute number. Next, we move on to the default risk. It is the risk that a lender takes on in the chance that a borrower will be unable to make the required payments on their debt obligation when due. Whenever a lender extends credit to the borrower, there is a chance that the loan amount will not be paid back. The measurement that looks at this probability is the default risk. Default risk does not only apply to individuals who borrow money, but also to companies that issue bonds and due to financial constraints are not able to make interest payments on those bonds. Lenders and investors are exposed to default risk in virtually all forms of credit extensions. A higher level of default risk leads to a higher required return and in turn, a higher interest rate. Moving on, we have here the purchasing power risk, which is the risk that inflation will undermine the real value of cash flows made from an investment. The risk that unexpected changes in consumer prices will penalize an investment's real return from holding an investment because investments from gold to bonds and stock are priced to include expected inflation rates, and the unexpected changes produces this type of risk. It is said that fixed income securities such as bonds and preferred stocks tend to subject investors to the greatest amount of purchasing power risk, since their payments are set at the time of issue and remain unchanged regardless of the inflation rate. Inflation risk can be clearly seen on fixed income investments. For example, if you buy a bond with a coupon rate of 3%, then this would be the normal return of your investment. However, if the inflation rate is 2%, your purchasing power is only really increasing by 1%. Moving on, we have here the liquidity risk. So it is a financial risk that for a certain period of a time given on a financial asset, security, or commodity cannot be traded quickly enough in the market without impacting the market price. Liquidity risk stems from the lack of marketability of an investment that cannot be bought or sold quickly enough to prevent or minimize a loss. With that, the investors or entity might be unable to convert an asset into cash without giving up a portion of the capital or income due to a lack of buyers or an inefficient market. For example, a 1 million house might have no buyer when the real estate market is down, but the house might sell above its listed price when the market improves. However, if the owners might sell the home for less and lose money in the transaction if they need cash quickly being forced to sell while the market is down. This portion of loss is referred to as liquidity risk. Next is callability risk. This is the risk that a bond issuer will redeem a callable bond prior to maturity. A callable bond is one that can be redeemed prior to its maturity date. The bond has an embedded option that is similar to a call option, giving the issuer the right to call the bond before it matures. For example, a callable bond is issued with a coupon rate of 5% and has a maturity of 10 years. There is a call protection of 4 years, which means the insurer cannot call the bonds for the first 4 years of the bond's life. So after the call protection ended, bondholders are exposed to the risk that the bonds may be paid off if the interest rates drop below 5%. So if the interest rates have declined since the bonds were first issued, issuers will call the bonds once it becomes callable and will create a new issue at a lower rate. This situation showcases the callability risk. Investors exposed to call risk are also exposed to reinvestment risks, since after the bonds are called before maturity, they might tend to have to invest again in a lower rate environment. Moving on to the convertibility risk. So this risk is the risk of loss arising from an inability to convert local currency into a fully convertible currency or that portion of return from a convertible bond converted at a time or terms harmful for the investor's interest. Basically, from the word convertible, it is the risk associated in converting the bonds into an issuer's common bond or a currency in an unfavorable time for the investor. Next is the currency risk. The currency risk is the possibility of losing money due to unfavorable moves in exchange rates. This risk arises from the change in price of one currency in relation to another. Currency risk can be reduced by hedging, which offsets currency fluctuations. Investors might want to consider investing in countries that have strong rising currencies and interest rates. Rising currencies are associated with a low debt to gross domestic product or the GDP ratio. We have the operational risk. So operational risk is the uncertainties and hazards a company faces when it attempts to do its day-to-day business activities or like the deviations from planned normal functioning system, procedures, technology, human failure, or commission of errors. Because it reflects man-made procedures and thinking processes, operational risk can be summarized as a human risk or the risk of business operations failing due to human error. It changes from industry to industry and is an important consideration to make when looking at potential investment decisions. For example, in a manufacturing company, choosing not to have a qualified mechanic on staff and having to rely on third parties for work can be classified as operational risk. Not only does this impact the smooth functioning of the system, but it also involves additional time delays. Next, we have here the industry risk. This refers to the dangers to a particular stock that stems from far more wide-ranging issues involving the entire industry that the company belongs to. It is the portion of an investment's total variability of return caused by events that affect the products and firms that make up an industry. Stage of the industry's life cycle, international tariffs or quotas on the product produced by an industry. A fictitious example of an industry risk might be what could happen to the oil majors in the extremely unlikely event that a radically successful type of solar cell is invented that overnight alters the power usage profile of our planet. The ensuing collapse in oil prices to say for example under $5 a barrel would hurt every company in the oil industry. Next, we have here the interest rates risk. So this risk is the potential for investment losses that result from a change in interest rates. Interest rate risk can be reduced by holding bonds of different durations, and investors may also reduce interest rate risk by hedging fixed income investments with interest rate swaps, options, or other interest rate derivatives. And lastly, we have the exchange rates risk, which is somewhat related to the currency risk. It is a risk referring to the losses that an international financial transaction may incur due to currency fluctuations. The exchange rate risk is caused by fluctuations in the investor's local currency compared to the foreign investment currency. These risks can be mitigated through the use of a hedged exchange-traded fund or by the individual investors using various investment instruments such as currency forwards or futures or options. Exchange rate risk isn't completely avoidable, but it can be mitigated.
Hello, I am Anne Gabriel G. Luna, and I am here to discuss about risk pooling. Pooling is one of the forms of risk management mostly practiced by insurance companies. Insurance is a way to transfer your risk to the capital market in order to survive any unplanned financial losses. In insurance term, risk pooling is the sharing of common financial risks even among a large number of people. So the capital markets here, insurance companies, take that risk from you in exchange for a regular payment called premium. The company believes the premium is enough to cover the risk. An interesting thing to note here is that you are not the only one getting insured. There are many people that try and seek the same kind of insurance covers. This group of people is called the insurance pool. The possibility of all the clients needing the insurance claim is almost improbable. Thus, if and when any such event occurs for a couple of individuals, risk pooling allows the insurance company to settle their claim. Risk pooling is an important concept in the supply chain management. Risk pooling is a statistical concept that suggests that demand variability is reduced if one can aggregate demand, for example, across locations, across products, or even across time. This is really a statistical concept that suggests that aggregation reduces variability and uncertainty. For example, if demand is aggregated across different locations, it becomes more likely that high demand from one customer will be offset by a low demand from another. This reduction in variability allows a decrease in safety stock and therefore reduces average inventory. Your customer value and business needs are the main drivers of your product offering, procurement and manufacturing strategy, and delivery methods. You also need to balance the trade-offs of various strategic and tactical decisions using the appropriate analytical software. But the concept of risk pooling helps you comprehend the impact of adding more products, options, warehouses, and any other complexity in your operations. There are three critical points to risk pooling. Number one, centralized inventory saves safety stock and average inventory in the system. Risk pooling involves using centralized inventory instead of decentralized inventory to take advantage of the fact that if demand is higher than the average at some retailers, it is likely to be lower than average at others. This reduction in variability directly leads to a decrease of the safety stock and eventually leads to the reduction in average inventory. Thus, if each retailer maintains separate inventory and safety stock, a higher level of inventory has to be maintained than if the inventory and safety stock are pooled. Therefore, the system with risk pooling has less overall inventory and is thus cheaper to operate with the same service level. The third critical point is The second critical point is when demand from markets are negatively correlated, the higher the coefficient of variation, the greater the benefit obtained from centralized system. That is, the greater the benefit from risk pooling. The third critical point is the benefits depend directly on the relative market behavior. If we compare two markets, and when demand from both markets is more or less the average demand, we say that demands from the market are positively correlated. Thus, the benefits derived from risk pooling decreases as the correlation between demands from two markets becomes more positive. So going back to the definition, risk pooling is the basis of the concept of risk pooling is to share or reduce risk that no single member can absorb on their own. Hence, risk pooling reduces a person or firm's exposure to financial loss by spreading the risk among many members or companies. It actually has three actuarial concepts used in risk pooling. Oh no, not three. Four actuarial concepts used in risk pooling are statistical variation, the law of averages, the law of large numbers, and the laws of probability.
Hello, ma'am. I am Bianca Fetch Cabintoy, and I'm going to discuss about risk reduction through diversification. So, what is diversification? It aims to maximize returns by investing in different areas that would each react differently to the same event. The important principle to consider is that in an efficient capital market, investors should not hold all their eggs in one basket. So what does it mean? They should hold a well-diversified portfolio. In order to diversify risk for the creation of an efficient portfolio, the concept of correlation must be understood. So correlation is a statistical measure that indicates the relationship between a series of numbers representing anything from cash flows to test data. So as seen in the figure here, if the two series move together, they are positively correlated. If the series move in opposite directions, they are negatively correlated. The existence of perfectly correlated, especially negatively correlated projects is quite rare. In order to diversify project risk and thereby reduce the firm's overall risk, the projects that are best combined or added to the existing portfolio of projects are those that have a negative or low positive correlation with existing projects. The gains in risk reduction from portfolio diversification depend inversely upon the extent to which the returns on securities in a portfolio are positively correlated. Ideally, the securities should display negative correlation. This implies that if a pair of securities has a negative correlation of returns, then in circumstances where one of the securities is performing badly, the other is likely to be doing well and vice versa in reverse circumstances. Therefore, the average return on holding the two securities is likely to be much safer than investing in one of them alone. So here presented are other benefits of diversification. It minimizes the risk of loss to your overall portfolio. Second, it exposes you to more opportunities for return. Third, it safeguards you against adverse market cycles. Last but not the least, it reduces volatility.
Good day, I am Rhea Kathleen Joy Anadeo and I am going to discuss about the total loss distribution. So, probability distributions can be very useful tools for evaluating the expected frequency and or severity of losses due to identified risk. The loss distribution approach relies on internal loss data as the basis of its design. The advantage of TLD, or the total loss distribution, is that it is based on historical data relevant to the firm. The disadvantage is that the data collection period is likely to be relatively short and may not capture short fat tail events. So, fat tails are a statistical phenomenon exhibiting large leptokurtosis, and this represents a greater likelihood of extreme events occurring similar to the financial crisis. And another disadvantage is that historical data is not necessarily reflective of the future because firms change product processes and controls over time. In risk management, two types of probability distribution are used. So first is empirical and second is theoretical. So to form an empirical probability distribution, the risk manager actually observes the events that occur as explained in the previous section. And to create theoretical probability distribution, a mathematical formula is used. So in conclusion, theoretical probability is based on the assumption that outcomes have an equal chance of occurring, while empirical probability is based on the observations of an experiment. So to effectively use such distributions, the risk manager must be reasonably confident that the distribution of the firm's losses is similar to the theoretical distribution chosen. The three theoretical probability distributions that are widely used in risk management are the binomial, normal, and Poisson. I'm not really sure how to pronounce it correctly, but anyway. The binomial distribution, for example, evaluates the probability of an event occurring several times over a given number of trials and given the event's probability in each trial. And the most commonly used distribution is the normal distribution, which is used frequently in finance, investing, science, and engineering. The normal distribution is fully characterized by its mean and standard deviation, meaning the distribution is not skewed and does exhibit kurtosis. This makes the distribution symmetric and is depicted as a bell-shaped curve when plotted. Furthermore, in statistics, a Poisson distribution is a probability distribution that can be used to show how many times an event is likely to occur within a specified period of time. In other words, it is a count distribution. Poisson distributions are often used to understand independent events that occur at a constant rate within a given interval of time. So the Poisson distribution is a discrete function, meaning that the variable can only take specific values in a potentially infinite list.
Hi, it's Andrea, Dahlia, Isabel, S. Melissa, and today I will be reporting about ruin probability. So this risk theory is also known as collective risk theory, and it is a concept used in gambling, insurance, and finance relating to the likelihood of losing all of one's investment capital. In ruin probability, we are actually computing how much is the likelihood of losing all of our investment. This was actually developed by the insurance industry for studying insurers' vulnerability to solvency using mathematical models. So the mathematical model used in this report is the Poisson distribution. It is a statistical tool where we can compute how many times the likelihood of ruin or an event will happen to the investor. So the formula presented is explained as follows. An insured surplus would be computed as a net of two opposing cash flows, which is the cash inflow of premium income collected continuously at the rate of C and cash outflow due to a series of insurance claims that are mutually independent and identically distributed with a common distribution function. So the number of claims received, which is N of T at a time frame of T, is controlled by a Poisson distribution with a mean of T. So the business insurer starts with an initial start and a level of initial level of surplus capital, which is x of 0, equals to x under a probability measure. So another mathematical model was presented towards the end of the 20th century by Garber and Shu, and they introduced the concept of the expected discount penalty function derived from the probability of ultimate ruin. So the concept was utilized to gauge the behavior of insurer surplus using the following formula, where sigma is a discounting force of interest, k is the general penalty function representing the economic cost of the insurer at the time of ruin, and expectation relates to the probability measure. So there are quite a few related quantities that fall into the category of the expected discounted penalty function. And this theory, the ruin probability theory, is applied in the case of risk and solvency of a company with a diversified business activity. Terminal insolvency would likely happen when business lines are not able to compensate the negative positions, and there are actuarial computations involved in determining the ultimate ruin. So that is all. Thank you.
My name is Dwight Stephen Tabanao, and I will discuss about risk analysis. So what is risk analysis? Risk analysis is the process of identifying and analyzing potential issues that could negatively affect key business initiatives or projects. This could consist of unfavorable situations or missed opportunities. This process is done in order to help organizations avoid or mitigate those risks. It is a standard of practice that ensures that the least number of surprises occur while your project is underway, which improves the chance of successful project completion and reduces the consequences of those risks. Next slide, please. Under risk analysis, we have risk mapping, which is used in operational risk management. Risk mapping is a process that requires identifying all potential risks to which the business is exposed, and then pointing out to which attention and monitoring should be focused on, given their high severity and likelihood of occurring, shown in a risk map. Next, please. What is a risk map? A risk map is a graphical process built by plotting the frequency of a risk on the y-axis and the severity on the x-axis of the chart. Frequency is how likely the risk is, or how often you think it will occur. On the other hand, severity is how much of an impact it would have if it did occur. We should keep in mind that the likelihood increases as you move up the vertical axis, and the impact increases as you move to the right. Next, please. The following is an example of a risk map. As you can see, on the y-axis we have the likelihood of risk occurring, and on the x-axis is the degree of impact of these risks. The dots in the graph are examples of the risks identified and categorized in the business. Those that are found on the red areas are risks that need to be attended immediately because they can hinder the operations of the company significantly. Next are those found in the yellow region, which are risks determined that need to be watched but don't require heavy mitigation from the management, unlike the previous one. Lastly, on the green region are the risks that does not impact the business significantly or would not likely occur. Also, there is a big black line on the graph, which is the critical issue tolerance boundary, wherein risks plotted above this boundary are considered intolerable and requires immediate attention from the management, while those that are found below this boundary does not require immediate attention. Next slide, please. For sources of operational risk, we have people risk, which includes human errors, accidents, and injuries, including fraud. Next is process risk, or the risk of incorrect working method or faulty business processes, followed by relationship risk, which should arise from loopholes in contracts, statutory violations, and penalties. After that is technology risk, or risk of unreliable machineries, obsolete plant, or software bugs. Finally, we have external risk, which includes disasters, riots, or wars. Next, please. For the scope, understanding of the scope of work is critical as it sets the scene for what needs to be done, and it further ensures that the final result is in line with the expectations of the management, which is to prevent or at least mitigate risk revolving around the business. Next. Here are some of the benefits of using risk mapping. First, it enables the business to determine the risks that could affect them from achieving their goals and objectives. It also allows the management to be able to hypothesize solutions to answer these risks. Next, after having numerous solutions, the business can then develop an action plan by choosing the most effective and reasonable solution that would mitigate or prevent this risk. It also assigns responsibilities to individuals for management of this risk to ensure that they are prevented. It also provides opportunities to mitigate risk, and it aids in strategic business planning.
Hi, my name is Fatima Rahma Jahadin and I will be discussing risk indicators. Key risk indicators come out as the result of the mapping process and should be used to provide anticipatory signals that can be useful for both operational risk prevention and measurement. They are critical predictors of unfavorable events that can adversely impact organizations, and they monitor changes in the levels of risk exposure and contribute to the early warning signs that enable organizations to report risk, prevent crises, and mitigate them in time. And they may also be partly derived from the experience of audit departments defining potential risk scores for different business units as a tool for defining priorities in their action plan. Next slide. Now we talk about the characteristics of key risk indicators. KRIs are typically measurable, meaning they can be quantified in terms of percentages, numbers, and the likes. They are predictable and are often used as early warning signs, while also tracking trends over a period of time. Since they offer useful insights about potential risks that may impact organizational achievements and objectives, KRIs are informative and act as a catalyst for decision making. Considering their importance, it is crucial that they are designed with care. Now, when selecting KRIs, we have to ensure that there are not too many because it would make them difficult to manage. Then select only those that offer concrete information and choose the ones that are measurable, meaningful, and predictive. Once these are determined, organizations should validate their trigger levels and thresholds and set these based on their risk appetite and tolerance, because the threshold over which the losses should be recorded is a particularly critical choice for risk quantification. If the thresholds were too high, only a relatively limited number of medium to high impact events would be recorded. A lower threshold allows one to model operational risk severity and frequency better, but also implies higher collection costs. Moreover, lower threshold requires greater effort to enforce the rules of the loss collection process at the organizational-wide level. Next, we move on to the challenges or reasons why KRIs sometimes fail to deliver business benefits. 1. Difficulty in identifying KRIs for all risks. 2. Insufficient focus on the causes of the risks. 3. Failure to automate the collection of the KRI values. 4. Not using existing KPIs or key performance indicators in conjunction with KRIs. And the last one, not associating actions with thresholds. But for each of these challenges, there are remedial recommendations. First, organizations should start with the key risks and then expand. For the next recommendation, they should assign KRIs against each cause. And for the third bullet, as many KRIs as possible should be automated to prevent them from becoming stale. Next, existing KPIs should also be mapped with the KRIs, and both should be used to forecast risks. Lastly, associating actions with thresholds goes a long way in synchronizing appropriate thinking when defining thresholds. A manufacturing company may assess risks of operational losses by reviewing its competitiveness in regard to technology adopted, competitor strength, and etc. Key indicators should build up early signs of deficiencies through information system interfacing between enterprise's changing environment and its adaptive organization. Such indicators may include the market performance, customers' feedback or complaints, and competitors' performance, orders in hand and inventory, input-output performance, cycle times, the work cycle times of different activities in value chain, or the order to delivery cycles in purchases and sales. Next, the supplier's performance in terms of delivery and quality compliance, plant utilization, cost per unit of product or service, and the financial ratios. And that concludes our report for the enterprise risk management. Thank you.